I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
Currency watchers, the euro and the British pound took a pounding in trading today. Why is that?
Well, two things going on there. One, which I don't really put much stock in, but it's in the news, is there have been rumors over the past couple of days that when the ECB meets on Thursday, the European Central Bank, that they're going to boost their quantitative easing program and announce a big money print. So that's actually helped their stocks go up overseas in Europe and caused the euro to drop. However, last year at this time of year, there were also similar rumors, and there was never any surprise QE announcement like that, and they didn't do anything until this year. What they tend to do is create rumors months ahead of doing something, and I think that's what they're doing once again. And then, of course, we got the U.S. dollar that's gone up, and there's an expectation that the Fed will raise rates in December, which they probably will, so that's affecting those currencies too. But I actually think the latter is not going to be a huge impact next year, that they'll probably just do it once or twice, and that's going to be about it. So I think we're really just seeing moves that are going to last a couple weeks, and that's pretty much it. And by this time next year, it might be completely the opposite. Black
Friday really was more of a Cyber Friday, with more Americans shopping online than in physical stores.
Yeah, well, I saw a funny headline, too, about that, and that is that the overall retail sales, if you combine both the online and the stores themselves, are actually down from they were a year ago. And they were down last year, too. So it's not like people are just going crazy buying stuff, even though they're buying more on the computers than they did a year ago. They're not really doing so when you combine both figures together.
And is there anything that you really need that's brand new out there?
No, not that I need. How many TVs can someone buy? You're not going to buy a new TV every single year, and it's the same junk that they have year after year. But one thing that's, to me, been the most interesting when it comes to the financial markets is a funny thing has happened this year, and that is the earnings that corporate America in the United States is making and announcing is less than it was a year ago. So the earnings have been shrinking. The profits of corporations is down. However, the headline numbers for many companies are up. So they tell you they're making more money per share when the companies aren't making higher profit. It doesn't seem to make any sense, what I just said. But the reason this is happening is because they've been doing stock buybacks and taking stocks and shares outside of the market. And that's actually been helping the stock market go up and helping the headline numbers that you see. And I think that's actually the biggest story of the year. And this actually started around 2013. The number of buybacks by corporate America just exploded. And they actually, as a whole, borrowed money to do these buybacks because they were doing more buybacks than they were generating in revenue, which is absolutely amazing. So that's been a big key to this entire bull market that I think actually came to an end in the bull market a couple months ago. But this phenomena is something that's really unsustainable. Companies can only borrow so much money, and if interest rates go up, then the cost of their borrowing is going to go up. They won't be able to do it. The junk bond market, in fact, has already been declining with yields there rising. So this is all going to come to an end. The main driver of the bull market, or higher stock prices, or stock prices going sideways, which is what's happened this year, is going to be gone next year, and I think that's going to cause stock market declines. I mean, the market itself really, the S&P 500 isn't even up 1.5% for the year, so it's barely done anything. And most stocks, there's over 5,000 stocks in the stock market, and 50% of them are actually down over 10% at the minimum. So what's happened is individual investors who play stocks and buy stocks, for the most part, have had a very difficult time beating the market, or they're losing money. And the reason isn't because they're bad at stock picking necessarily, but because most stocks have simply been falling all year long. And that's been masked by the fact that the stock market averages are up a little bit, and that's happened because of these buybacks. And there's about 24 stocks in the S&P 500 that have done really well, such as Nike, Apple, Google, Amazon, Activision, but it's only about 24 of these. I mean, these things have gone straight up, and, if you're picking stocks, the odds that you're just going to happen to pick these couple out of, the thousands of choices you got, or a couple thousand choices, it's just not likely. And if you're a mutual fund manager who owns 50 stocks or 100 stocks, it's going to be very difficult to beat the market too, because what are the odds that you're only going to pick these couple winners? What I'm suggesting is this has actually been a very difficult year for most people who simply go long stocks, and it's just going to, this is why. If someone looks at their brokerage account and hasn't done well, this is the reason why. And this is probably just going to get worse next year. You can bet against stocks or use other strategies to adjust to this, or get into other markets. And I think gold, commodities will go into a bull market. I know I've been saying that for a year, but if you look at gold and the mining stocks, they fell hard in July, rallied in October, and then they came back down, but the mining stocks are doing better than gold. They haven't gone to the July lows. And if the Fed's only going to raise rates once or twice, then that's going to be a positive catalyst for gold once it happens, because there won't be any more rate hikes to worry about, especially if the stock market drops in the first couple months of next year. All the talk of interest rate hikes will kind of vanish. So we're in kind of like right now a very quiet period in the markets. Doesn't really look like much has happened. Last week, the S&P 500 didn't even move 1% from Monday to Friday, and even the month of November, it didn't even move 10 points. So as we start December, it's like nothing's happened, and people are falling asleep. And I think it's going to be a quiet before the storm that really starts to hit in January. But we might hear some rumblings here right around the time of the Fed meeting.
Do you think people could be lulled into a dangerous place where it'll happen so fast that you won't be able to react?
Well, that's kind of what happened in August, but I think we'll have time. I mean, if the market, this month, if the market were to fall this month, I wouldn't expect a giant decline to take place, and I think we would see some sort of bounce at the end of the year where people would have a chance to get out if they chose to. So I don't think we're facing like a sudden collapse that you won't have time to get out of it. I mean, I think, if the market does fall, say the S&P 500 goes below 2,000 or down to even 1950, which is where the solid support is right now, we would probably get a bounce back up to the 2,000. So people would have time to get out, and then if it goes through 1950 next year, that's when the real more dangerous drop will happen. It'll be when you fall, have another decline, and then a bounce. That support level will be the key level from then on, and if that level gets broken, that's when, the situation will be dangerous. But it'll take, months or weeks at least into next year for all that to take place. So, the important thing is just not to fall asleep, not to just say, oh, nothing's happening, or they tell me on TV it's going to go up, and and it's gone up since 2009, so I have nothing to worry about, and we can never have a bear market. You can't think like that, which is the dangerous thing, is I think so many people are, and it's hard for people to think something's going to change. It's just like the gold situation. Gold has fallen since 2011. It's difficult for people to think it can ever go up again, and just as something goes up for a long time, is people predicting Dow 30,000 and 50,000. There's people predicting gold to go to 900. I haven't had someone ask me if it's going to go to 350. So all these things change at some point, and the key level for gold is if it goes through 1,180, it'll be in a new bull market. But I can't predict when that's exactly going to happen. But one day it will. And the key really in investing is to be able to catch these points where things change, and no one can predict the exact moment, but you got to keep your eyes open so that when it happens, you're ready to make the changes you got to make.
We'll have more with Mike Swanson right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson. Mike, I know you've been advising people to keep a lot of your portfolio in cash right now so you can take advantage of bargains when they do happen. Have there been any bargains to grab right now?
Well, I don't have it. Actually, I don't have a huge amount of cash. What I tend to do is average in to markets that I think will be attractive or at low prices now that I think will go up. So I've really been averaging into gold and commodities and mining stocks, and then counterbalancing that with short positions. But as far as stuff being attractive right now, I do think the gold stocks actually are probably the best things to buy at the moment, because I do think they are in a position to have an end-of-the-year rally, and they are oversold. We had a big drop in them last month in November. So I think that's a place to buy. There are other markets I think that are going to be interesting buys. I'm interested in the Russian stock market, maybe oil and energy, but at some point. But both these markets I think are like 6 months out, or a little farther in the future. So I think there's going to be better or more things to buy next year. But as far as the U.S. stock market, people are really left to three choices. One, just buy now and hope it just somehow goes up as people predict, which I think the odds of that happening are very, very small, or bet against stocks, which is something I'm doing, or just be very patient and have a cash reserve and so forth. And really, that's probably what most people should do, is have some sort of cash position in their portfolio and reduce the risks that they have overall in their account.
I know people are like sheep. They like to follow trends. By the time a trend develops, so usually you're on the wrong side of it, aren't you? Well,
one thing that does happen is everybody. It's not just, it's just the way all our brains work. I don't care how long you've been in the markets. One thing that happens to people is when you see something go down, like the gold stuff has gone down over the past couple of weeks, it's hard to buy because you think, well, it can go lower, and that's definitely true in anything that declines. Even if it gets oversold and it's time to buy it, it can still fall more. But then on the flip side of that, people see something go up, and then they think, well, now it's safe to buy, when it actually could be the most dangerous time. So what happens is when something rallies, that's when people do most of the buying. They don't buy on dips, they buy on rallies. Then they end up losing money. Now, in a bull market, what will happen is someone will buy into a stock that goes up a whole lot, or they see it go up, and then they see it fall, and they sit there holding on a loss, but then it'll come back up and go up higher, and then they'll start making money. So the market, because it's so bullish, enables people to make money even if they buy at the wrong time or buy into tops or lose money for a short period of time, because it goes higher and higher eventually. But then in a bear market or the end of a bull market, that stops happening. So what will happen is people will see a rally like we had in October, and then they get excited and buy, and then the market comes back down or it doesn't go up and they're losing money. But they don't want to sell because they've done this before, and as long as they were patient in the past, they started making money again. So that's kind of the situation most people are really in at the moment. You know, they bought into the July top, or they're talking about active traders, or the October top, and they're sitting there with small losses, hoping it'll go back up like it did last year and the years before. But in bear markets, that all changes and leads to big losses. So that's kind of what happens. You know, in bull markets, you could buy high and still make money, but at some point, you know, that strategy can lead to disaster.
I know. Well, all the people have been saying for the longest time that markets are oversold, the stocks are overvalued, and yet people are still getting in. Is it hard to explain?
They don't really listen to any of that or trade on that. They don't really make decisions based on earnings or fundamentals at all. And then suddenly stuff matters to them. So the stock market, in a certain sense, that can seem to be the correct thing to do. The stock market has been overvalued for several years. If you go by the cyclically adjusted PE ratio, it hit a high about 2 years ago. If you saw Robert Shiller, who invented that, he's been on CNBC several times warning people, and only 2 times where that valuation level has been higher than where it is right now is 1929 and 1999. So the problem is to assume it's going to do that again. You have to assume we're going to have something like the internet bubble appear in the stock market over the next year, and that's just not, you know, there's no sign that that's going to happen, and there's not a speck of evidence that's going to happen. So there you are. But people just don't really base decisions on fundamental valuations or earnings at all. They don't. You know, they have a very superficial understanding of what they're even buying. I mean, they either look at a stock chart and just go by that, or they just say, well, I just like Apple, or I just like this other company because I like their products. But they don't really know anything about the company's earnings or the balance sheet or valuations or anything. So it's just it's the way it is. And you know, the professional investors, the mutual fund managers, the people you see on CNBC, they're not very much different either. In fact, they're in a position where they must buy stocks, because the biggest danger they face is if the stock market goes up and they're not in it, then their clients will take the money away from them, or you know, they'll be out of business. So they have to be in the market when it's going up, and for them to be cautious is a grave risk, even bigger risk than losing money in a down market. So everything's kind of skewed for everyone to be bullish on the stock market, except for a few people that, you know, are considered to be cranks by everyone else who's always bullish all the time. So that's basically the way it is. And then a bear market comes and everyone gets hurt, and then people start to listen to the bearish people, such as myself. And then once you get everyone listening to someone like me, then you're at the end of a bear market, and it's time to buy. And hopefully I'll be able to realize when that happens and be buying at that time. I think that's where we are in gold, by the way. It's like I brought up several times in the interview, because just about everyone is bearish on gold right now. A lot of people trying to short it. If you look at the Commitment of Traders report, small individual traders in the futures market are net short gold. They were net long gold about 50,000 contracts in 2012 in the fall, right before it started to really jump really bad in 2013, and now they're net short, so it's like 6,000. So it's an amazing swing that's taken place over the past couple of years in gold, and I think something similar will take place in the stock market in regards to people's feelings and sentiment to that too.
Mike, thanks a lot for chatting with us.
Yeah, it's great to talk with you, and I hope you had a good Thanksgiving.
Sure did. My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.